one thing I've been looking at is that there's polls. They ask, and this relates to the election. There's polls that say, what is your biggest problem right now? What are you most concerned about? And while macro people are looking at the economic data, looking at the PMIs, looking at new orders, they're reaching out to your contacts. Small business owners certainly know the economy's bad. But if you ask the typical person, they'll say inflation is their biggest concern. And then other top answers will be gasoline's too high, which is another way of saying inflation. Or they'll say housing and rent is too high, which is another way of saying inflation. So it's like the vast majority of the answers were inflation, whereas labor market weakness is very, very, very low in the list. And so if you're the Fed or you're the Treasury and you think you're operating a dial and you want to boost up, you want to shift around the sentiment a little bit. One would think that they would hike until they break something rather than just, almost break something.
Wow, what an amazing conversation between Lynn and Luke. I certainly learned a lot there. What stood out to me, I think, was how recession seems inevitable. And it isn't really a case of if, it's a matter of when. But the key question that everybody's trying to work out in the market is, as it relates to Fed rate hikes and their price targeting, so in other words, going after inflation, when could we see a pivot? So when are the Fed likely to capitulate? So at this month's July meeting, the Fed's expected to increase rates by 0.75% or 75 basis points, which surprised markets last month when it came in at the same size, 0.75% versus 50 basis points previously expected. So it seems as though the Fed has been front-loading these rate increases, but analysts don't see any likelihood of a terminal rate of less than 3.75%. So there's still quite some way to go before, as Lynn and Luke put it, something may break in the economy and then they pivot. So I think to summarize, Luke sees the potential for a pivot coming perhaps sooner than others anticipate, based on some of the recent rhetoric, but more importantly, the horrendous showing in many of the lead indicators of the business cycle. He noted, for example, some anecdotal evidence coming from real-time data or real-time indicators, effectively freight and shipping around the world, heading into from, say, China and the East across to the West Coast ports. Reports of massive slowdowns there in activity going back as early as March, so 3 or 4 months ago now. The rest of the data, when you look at the housing sector, it pointed to the NAHB home builders survey, which has collapsed. Similarly, ISM new orders, for example, really rolled over and is now below 50, and a bunch of other very important lead indicators. They've all since confirmed the early doubts that Luke had. So we're seeing the slowdown. A recession seems inevitable. It's a matter of when the Fed pivots. So many people are drawing comparisons to the 1970s as the last inflationary decade, where inflation was truly out of control, as it is arguably today. The difference is that whilst inflation is at a similar level, the Fed funds target rate or interest rates have barely moved, even though they've increased in this hiking cycle at the fastest pace since 1993. So that shows how seriously the Fed, how aggressive the Fed is being in moving to try and get inflation under control. But it seems as though the economy is going to have collapsed, or growth is going to have collapsed, before they get to the point of taming inflation via rates. So it seems as though it's inevitable that a recession is what is going to bring inflation under control. And as I say, it's a question of timing. So in terms of what may be likely, what tools do the Fed have at their disposal? After all, a lot of the focus of the conversation was on the midterm elections. So we're in an election cycle as we approach the end of the year in America. So increasingly central bank decisions, the policymakers aren't behaving with the independence that they're supposed to have, they are increasingly behaving like politicians, as Luke pointed to. So the likelihood is that they're now in a position where they've got to appeal to voters in one of two ways. They're either going to go into it with an inflation problem, where they haven't been sufficiently aggressive in their interest rate hikes, which looks to be, they probably will be or are being sufficiently aggressive, and they probably will begin to chip away at inflation. But the likelihood is that they're hiking into this recession and into this slowdown, which will then pose a different dilemma or a different set of problems with rising unemployment. So the consumer and the voter in the US is very much focused on inflation at the moment rather than recession, although there are, of course, sentiment indicators which are beginning to show that as well. So it's a rock and a hard place, as I say. There's no easy way out, but the end result of this is ultimately a pretty horrible looking recession if things continue in the direction they're going. So just before I go on to the implications of what this means for us as investors and you and I as members of the public, citizens around the world, we need to just focus on a couple of things. It's not a time to be using leverage and to be day trading and doing all that kind of thing. It's a very risky, volatile and uncertain environment. And it's likely to remain so for the next few months, according to what Luke and Lynn discussed. And I share that view also. If you are going to position for basically the slowdown and the continued hikes, where the Fed just isn't going to capitulate or back off pivot between now and the end of the year, then likely the only safe haven, or one of the few safe havens, is going to be the dollar or cash if you're an American investor, and possibly volatility if you can play volatility in a clever way. But that's not for everybody. So there are going to be few hiding places in the bad scenario. As we do approach the end of the year, though, and we could see the pivot that Luke's talking about, and Lynn also talks about when it comes to the Fed breaking something through rate hikes, reaching that critical point. If it comes this year, but when the pivot comes, then it will be very much game on again for the inflation or reflation trade. Now, a little bit like we've seen coming out of the pandemic, albeit there's a heck of a lot of stimulus behind that. I think Luke said the Fed expanded the balance sheet by 50% over the last 2 years, an incredible amount. We're probably going to see persistent inflation. And this for me is the key takeaway. Even if we end up in a scenario where I've talked about, the SLR, for example, it's reducing the bank's reserve ratios to stimulate in a way that isn't called QE. If the Fed pivots, it stops hiking rates, and it does, QE by another name, then there's going to be more inflation through asset prices and through, I think, structural shifts that Luke mentioned in terms of having seen perhaps peak cheap energy. That's going to see inflation persist. Now, if inflation persists, it's very much like the 70s, where we'll see perhaps these recurring spikes in inflation that need to be brought under control each time. But we may already be in a low or stagnant growth environment whilst we're experiencing this volatility and these recurrences in inflation. And that's a real problem. That's a stagflationary environment. So the portfolio strategy that Luke talked about longer term around perhaps having 25% in cash, 25% in gold, which of course tends to appreciate during inflationary regimes. Real estate also tends to perform better than other assets, other cyclical assets. And then 25% in equities is something that makes sense to me, at least. And staying away from bonds is also something that he sees. So that's the complicated stuff. There's obviously speculation and uncertainty in all of that. But regardless of whether you're an investor or viewing this from the perspective of maybe friends and family members who don't necessarily have an active interest in markets, but are worried about what this means ultimately for their livelihoods and what this means for the next few months, next couple of years, recession seems inevitable. It's looking ugly. rates are likely to continue going higher until a point that something breaks, and that could make the recession even worse. So what we need to be cognizant of is, first of all, preserving cash or savings as best as you can, focusing on, to the best extent possible, keeping your job so you maintain that income as well during a tough time or what looks to be a difficult time. Doing all of that is key. And on the investment side, not taking too much risk now. So the recession will create opportunities, but there are going to be job losses, more job losses. There is going to be likely a lot more stress in the financial system and probably more risk in terms of drawdowns in stocks, bonds, maybe pretty much everything for the foreseeable future. So now is the time to be more cautious and focus on preserving what you have. And investing for the long run is great, but if you lose your income in the meantime, it's no good if you don't have cash. Recessions provide an opportunity to those with cash. So that's the most important thing. So whether, as I say, you're viewing this as an investor or you're looking at it as a fellow citizen of the world, you have friends and family, as I say, who maybe aren't as active in markets, that's, I think, the takeaway from the conversation. So lots of fascinating stuff in there. Really enjoyed listening to it. I think the Fed ultimately, just my personal take, is that they are going to continue hiking until something breaks. A recession is inevitable. I'm completely aligned with Luke's view, have been for some time, that we're heading in that direction anyway. And I think that the Fed is probably going to engineer, as I've begun talking about, they're quite happy to engineer an environment where asset prices, so household wealth, which Lynn talked about, is ultimately deflated, or that bubble is burst. Prices come down, prices of everything relative to GDP, in order to try and tame inflation. Whether or not that will be successful long term, remains to be seen. I'm not convinced of that. I do see the potential for there to be these recurrent inflationary spikes as we saw in the 70s. And just to sum up, it did make for a difficult decade for investors. So whilst there may be a lot of speculation over the next meeting or the next couple of meetings and through the end of the year when the pivot comes and election cycle and all the rest, this could be a difficult era for investors. And it's really important. The key takeaways from the conversation, as Luke mentioned, is that you're not taking too much risk, you're not relying on leverage, and that you basically preserve your capital as best as you can, and that you remain patient for the right opportunity. So with that, that's my 2 cents.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.